If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. Or why not visit our website where you can download a free trial of BetAngel Professional, but also visit the forum where you can get detailed images, examples, and downloadable files. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So if you're going to trade effectively, you need to create a trading plan of some sort. So what a trading plan does is it gives you definable boundaries. So it's going to dictate when you get into a market, what your exit points are. You need to come up with a trading plan of some sort. And it's basically going to define what you're going to do in that particular market. And the primary reason for doing this is so that you have something that you can replicate. If you can perform a set of actions and you can replicate those actions, then you have a chance of influencing. But if you just go into the market and you're just sort of clicking around at random, doing stuff and using varying stakes, and you'll never ever get any consistency, because sometimes you'll win, sometimes you'll lose, but because of commission and other things, you'll probably end up losing in the long term. So you need something definable that you can replicate. But also a great thing about doing a trading plan is it keeps your emotions in check. It allows you to basically say, if this, then that. You will find, however, when you do a trading plan, when you first start doing it, you're going to be slow and you're going to be behind the market, and you probably will be pretty useless, if I'm honest, to start with. But it's critically important to have something that you can replicate and work on. And then over time, you'll get better and better at it. It's a bit like riding a bike. When you first sat on a bike, you wobbled all over the place and didn't go very far. But as time moves on, then you get the opportunity to progress and get better and better. And I have analogied this to bike riding before. So, I've often said that when I'm out riding my mountain bike, I trade like that. So, I'm always on the edge of what I can do, but I know if I push it too hard, I'm going to crash. And the same occurs when you're actively trading. There's a bit of a balance to be had there. If you want to beat the guy next to you, you're going to have to push things a little bit harder, go a little bit faster, be a little bit fitter, and stuff like that. So yeah, having a trading plan will actually allow you to keep your emotions in check. It will allow you to define what you're going to do. It will allow you to replicate what you're going to do. And then it will allow you to get better at that as well. So when you first do it, you're going to be slow and you're going to feel a bit of a fool at times. You're going to fall off your bike. But when you get a little bit more practiced, then you can actually push a little bit harder, be a little bit quicker, and find where your edge is. How fast are you willing to go? How aggressive do you want to be? How soon do you want to get in the market? Stuff like that. So having a trading plan is probably one of the key, most important aspects when you're first trading. You need to be able to replicate something and progress it. So other key steps that you need to go through and you need to think about when you're doing your trading plan. What strategy are you going to use? Are you going to back? Are you going to lay? Are you going to do it pre-off? Are you going to do it in play? What specific thing are you going to do? Now, because I've traded the markets over a very long period of time, and I've traded hundreds of thousands of them, I can turn up to a market and just go, oh yeah, I recognize this, away we go. But typically that's not the best way to do it, because what you're seeing there is the evidence of years and years and years worth of practice. So I can recognize opportunities as they present themselves, but a lot of people are unable to do that. So you need to pick a strategy. And when you first start trading, you need to basically say, this is the strategy that I'm going to use and the one that I'm going to practice, refine. And then when you master that, you can move on and deploy more strategies. That's exactly how I started. I started with a really basic, simple strategy. And from that has spawned hundreds of strategies off the back end of that, and millions of variations. Slight exaggeration there, but you can hopefully understand where I'm coming from here. That's experience, and learned experience allows you to define it. But everybody starts from the same point. One simple strategy, practice it very well, branch it, evolve it, and adopt other strategies, and then learn when you need to deploy those. And that's the important thing as well, deployment. Which market you're going to do it in. Just because you have a strategy doesn't mean that it's going to be deployed across every single market. What you need to do is define markets that you will and won't use this strategy in. Because if you apply a generic strategy in a generic market, you're going to get generic results. You will probably lose money. So define one strategy and then learn how that works within individual markets. You may find that there are certain markets that it works particularly well in, and therefore you should sort of head down that route. And it's a good way of cutting losses as well. If you use that strategy in a market and you keep losing money in that particular market, then just bin those markets. Don't bin the strategy. What entry point? You need a defined criteria for entry. So you need to come up and saying, well, if this happens or this is the situation, then this is the point which I get involved in the market. And of course, when you're in the market, you need to define what are you looking for? What would define a successful trade? And where is the limit of that successful trade on the upside? Because if you define the upside, you'll automatically define the downside. Or you could do it the other way around. How much money am I losing with this strategy? What do I need to do to make it profitable? Whichever way you look at it, these two are interchangeable. So that needs to be part of whatever trading plan you have. How am I going to define success? Am I looking for 5 ticks, 5%, £100? There has to be some definition of where and why you're doing this strategy, because you need, therefore, to understand what you need to do to make your trading long-term expectancy positive. So you need to know, before you've even done the trade, roughly what your up and downside is going to be, and where you're going to aim that, because both of those will define your strike rate as well. We'll talk about this in a minute. And then necessarily, when you're going to get out. When do you realise that everything's gone horribly wrong and you're going to have to live on water and bread for a week? It's important to understand each of these characteristics. This will all be part of your trading plan. So let's look at a simple strategy. For this one, we're going to be looking, simply because I did a video on it recently, at finding a steamer, something that's being heavily backed within a particular market. And this is just one of a number of strategies. So you're not limited to specifically trying to deploy the strategy across every single market. You may pick this strategy only for certain markets and a different strategy for other markets. But what I'm saying here is develop a strategy, practice that strategy, and see where it leads you. So how would you find a steamer? Well, you can see from the graphic that's behind me, obviously one of the things that happened this year, and I have highlighted this repeatedly, endlessly over a number of years, is when you get this jockey trainer gamble thing that can occur at a large meeting. If somebody wins, or a jockey like Frankie Dettori wins a race, then people may have a tendency to start backing the next one, and they may follow that up if he wins again and stuff like that. So there are a number of ways of identifying where potential interest is within a market. But when you actively look at a steamer, it doesn't have to occur this way. They can occur organically, naturally. Things can happen that encourage people to bet on a horse. So typically what you're looking for, even if you didn't know who Frankie Dettori was and that he'd run the previous 3 races, you'd be looking for consistent backing. So there's a certain type of behaviour in the market when you're looking at horse racing where you can see persistent backing. The price on the favourite is basically going to start up here and then gradually work its way in, and it may be a little bit erratic, but you just see these repeat back orders gradually pulling the price down. So you're looking for consistent backing within the market. Now, you obviously want consistent backing, but also if it reaches a certain point within the market and stalls, then you may find that it actually ends up reversing. So typically what you're looking for within a market is some for a consistent steamer to be able to break support. It reaches a critical point in the market but just passes straight through it. That indicates to you that nobody's willing to lay it and that the money will continue to go. So consistent backing and breaking support are 2 key things that you should be looking for with a steamer. But also you're looking for supporting evidence as well. What's going to stop the favourite from heading much lower? Is there something happening somewhere else within the market, or maybe even pictures from the course? Maybe the horse is just not looking particularly comfortable, or the commentators are saying, he's looking a bit frisky on the way to the start, or he's not leaving the parade ring, stuff like that. Then you probably sort of, be a little bit more cautious. But also have a look at what's going on elsewhere within the market. You often see me doing this, and the next slide I've got has an image from a video that I recently did. And it was quite simple, really, because we can see that one of them is being backed, one of them is being laid, and we can't make our mind up on this particular occasion about the favourite. And then what actually happened, if you watch this video, is you'll see a large back order come in, it breaks support, and then the price starts to come down. So it's quite a good example. But the funny thing about this is, we're looking for a steamer in the market. If I look at this particular trade on the favourite, I wouldn't say that this was a typical sort of steamer-driven market, because really what you need are for the two runners that aren't the favourites to be gradually drifting over time. If they're gradually drifting and there's no predominant backing on all of them, that's going to pull the price on the favourite in. So what I actually did on this particular video was I couldn't make up my mind about which way the favourite was going to go. I was waiting for the breakouts to occur, so I went for the next best option, which was the second favourite, and I was looking to catch the drift on the second favourite. So, not to confuse things, but basically what we're trying to do here is we're looking for a general trend within the market. Is there momentum that is occurring? Is the favourite being backed in? But is that being supported by others that are beginning to drift out? So if you see that, you're going to score that highly as you're looking for potential backing activity. It's broken support and you've got two runners that are drifting. That looks like a nice trade. If you can't see that, then you'll probably lower your risk. You'll probably feel less comfortable with what you're seeing, and therefore you'd probably score it lower, or you may even skip it. So, this is when we're talking about entry and practice and trading plans. You're looking for something very specific. When you first start out, you'll be looking for the perfect trade, which probably won't occur. And over time, you'll begin to adjust that by saying, well, this is generally pretty good, and I'm willing to, have a go at this particular trade. It's very difficult to get a trade that's 100%, absolutely definitely know what's going to happen. You're going to have to get used to that feeling, because that is essentially the essence of trading. You're taking risk in return for some reward, but, some of that risk is going to be undefined, and you have to be the judge of whether you're doing that. So yeah, there are very different grades. On this particular example that's behind me, we would sort of say that, the favourite, we couldn't make a firm judgment on this. We'd have to wait for confirming information. But a lot of other markets are, much, much clearer. But in fact, what I should do is talk you through some examples of the sort of thing that you're looking for that take account of some of the stuff that we've discussed already. So when you're looking at backing a steamer, you'll expect the price to sort of be gradually moving down in some form or another, but there are sort of many patterns in the way that it moves. Now, obviously, if more people are backing than laying, then the price has to come down. So essentially what you're looking for is backing activity in the market in some way or another. Now, you can look on the ladder that will give you an indication as to if you're seeing backing activity, but typically, something that looks like this is not particularly common. And, very often you'll sort of see boom, and the price goes out, and then boom, and then the price goes. So you'll often see activity that sort of goes like that. Or you could see a period of stability, and then the price comes in, and then it sort of retrenches and then carries on. But essentially, you're just looking for this, fairly consistent downward movement. If you're watching the ladder frequently enough, you'll be able to get a feel for it. You'll see activity building in the market and pushing the price down. So, there are several patterns that develop that give you a clue as to how this is happening. But, if you see the market sort of doing this, then obviously, there's a slight bias, but not a significant one. And as I've said in videos before, you have to grade each opportunity as you see it. But if we start to put together a few of the things that we've talked about already in this video, then hopefully you'll be looking at something that is generally trending down. Now, what can happen now and again is it trends down for a period and then it sort of flatlines. So what tends to happen when the market stays at the same price for a period of time is you tend to sort of get a build-up of volume at that particular point within the market. So, I'm going to do a really rough and ready volume indicator here. It's not a very good one, if I'm honest. But hopefully, I should have done it a certain colour or something. But basically, the amount of money that's getting matched sort of tends to congregate at one particular point or another. So at this particular point, you're looking for a breakout at this particular moment in time. So we're looking for a steamer, we're looking for consistent backing, but all of a sudden, the market is sort of stuck in a certain point and volumes accumulating in one direction or another. So at this particular point, if the market's stuck for a while, then you may find that it breaks down. So if you get a large order that breaks the price further, then you can sort of think, well, okay, this probably is heading in that direction. But, you could also see the price tend to go up, but typically it will sort of bounce one way or the other. So if you see the price come down and then it sort of, meanders above the line from here, each time that you're seeing it bounce,
let's do this. Each time that you see it bounce at these individual points, it's getting less and less likely that the market is going to continue to occur, is going to continue in the trend in which it was going. So when you see it bouncing like this, you each time that it bounces, you're sort of going, oh, not sure where it's going. It's probably going to go up. In fact, I definitely, and then, you're forming a judgment like that. You're basically saying it's looking more and more likely that something like that is going to happen. So really what you're looking for is for the price to sort of head below the key point and then go up and touch, and then maybe that will continue onwards from there. So around that particular level, you'll begin to understand that it's hitting a point of support or resistance at that particular moment in time. And you can take your cue as to where you go from there. But also think about it, if you see a market that exhibits this type of activity, there's no reason why you couldn't do a trade in the other direction. You could basically say wait for the price to come down, and the price will head off in the other direction. But you're talking about doing a swing trade, looking for a reversal or a bounce, depending upon how much time you've got left within the market. But when you get to this scenario where the market begins to stall, then you're either going to have to sort of say, well, maybe I need to exit my trade, or you need to look for confirmation as to whether the price is going to continue to push on below this particular level. So you need to see continued backing, or you need to see the market bouncing around below where most of the money is within the market. Because if there's a big chunk of money here, as we head towards post time, that money will increase, but it will, sort of tends to develop a direction of some sort or another. But you can get a clue when the market begins to sort of stagnate like that. But ideally, you want a strongly trending market. You want a market where there's a significant amount of money coming for a runner, and you're sort of seeing repeated backing within the market. Those are the strongest trending markets. And basically, as time goes on, you can begin to identify all of the key characteristics, but maybe stick with one when you first do it. That is fairly clear and obvious, and start looking for that rather than confuse yourself with all of the other patterns that can develop. So try and keep an eye out for a persistent pattern in one direction. And if the market stalls at one particular point, you're really looking for the price to sort of maybe bounce up towards that level, but not beyond it. But you could probably sort of say that if that point is well above where you are at the moment, that probably brings you a little bit of safety, but it's below where you are at the moment, then that may actually halt that particular trend. Now, you would have seen me do this on videos as well. When you're actually in a trade, it makes perfect sense to define what you're going to do. This is where I'm going to put, you decide that you're going to get in at a certain point within the market because all of the characteristics that you wanted are present. But at the moment that you get into your trade, you're beginning to define a point at which you will place your closing trades. You see me do this all of the time. I'm sort of saying, well, I think we're in here. I think it's going to go up there. And therefore, this is where I'm going to put my closing trades. But I'll also look behind my current position and say, well, this is where things, I'll define this trade as having gone wrong. Now, it doesn't make sense typically to just have a rigid boundary, because if something happens somewhere else in the market, you may want to be a little bit flexible. But that's why you see me break up trades as well, because if I'm confident that the trade's going well, I'll put more trades in. And if I think it's going to go further than I expect, then I'll just slow down my exit. And this is why you see me trade the way that I do, because what I'm trying to do is to get in the market at roughly the right point and out at roughly the right point, but I'm leveraging and maximizing the opportunity that I have within that market. So if I think it's gone really disastrously wrong, then I'll just dump everything straight away. But generally that's not the case, because I'm very good at getting the right entry points within the market. But once you're in the market, you have to define what that range will be, because that will define your expectancy in the longer term as well. So it's important that you actually have an idea of what you're going to do and when, and that will help you execute better trades as well. So as we come to the end of this presentation, the thing that I want to reinforce with you finally is about your trading expectancy. And the reason that we're setting up a trading plan and that we're defining our entry and exit in the up and downside and all of those things is so that we have some metrics to measure our trading by, but also so that we can actually begin to influence that. So on the slide that you can see behind me here, we've sort of got a number of win rates down here. This is your strike rate when you do these types of trades. And it's not really your percentage strike rate that defines your overall profitability. So you could have a 98% strike rate, but if you lose a lot of money when that loss comes in, then you're still not going to make money. And in the same measure, if you have a very low strike rate, then you could still actually win as long as you win more than you lose. So very often trading is about not getting yourself into trouble in the first place, picking key points within the market, areas where there are less likely to be downside, and then letting the trade run to its full extent when you get the upside. You don't want to cut your losses too soon, because the market that would reduce your strike rate. But by the same measure, you don't want to let them run out of control. And it's the same in the other direction. If you've got a good trade underway, you want to maximize it as much as possible, but not to the point where it reverses and comes back in the other direction. So you need to measure your strike rate, how much you win when you have a winning trade, and how much you lose when you have a losing trade. It's important to have all of those three things, because they will form your overall expectancy. And what you can see on this slide is, we've got one race, or one strategy rather, that has a 30% win rate. We win £10 every time that we do this trade successfully, and we lose £5 when we do it unsuccessfully. But at a 30% strike rate, we actually make a small loss. However, with a bit of practice, we bump our strike rate up to 40%, and we actually lose more than we win. But because we're getting half decent trades through the market, we're actually slightly more positive. And your aim as a trader, your mission as a trader, should you choose to accept it, is to try and get your strike rate up as high as possible, and that balance between your wins and your losses in the best ratio possible as well. So big wins and small losses. It's not always going to happen like that. But what you'll find is if you have a trading plan, it will basically present a win rate to you, a strike rate, and it will also present how much you're winning when you win and how much you lose when you lose. And then you can start to understand where you're going wrong. Are you letting your losses go too big? Or are you not making your profits big enough? Or is your strike rate just appalling? Or perhaps you have your strike rate is high, but you're taking the losses, or taking too big a losses is the word I'm looking for. But if you have a defined trading plan, you can plug these figures together, and that will tell you where you're going wrong, but also what you need to achieve as well. If you know what that win and loss ratio is, that will define your strike rate. And if you have a win rate and a strike rate, that will tell you what your losses could be. So using all of that information together will allow you to become a profitable trader.